Good afternoon, everyone. I'd like to welcome you all to the Halftime Talk feature interview series. I'm delighted today to be joined by Toby Copson, Managing Partner at Davenport Energy. Toby, thanks so much for joining us today, and we're going to be focusing on the Asia Pacific region
Yeah, well,
and
thank you
all
for
things
having me.
energy
It's a pleasure to
trading.
be on.
Great to have you. Great to have you. We have a daily energy markets show where we get obviously opinion and analysis from all across the globe. And one point that has been reiterated in the last week, to me at least, is that the energy markets are still relying on China to obviously, as always, it's a huge support for the market, but this inventory stock pile up that was sort of at least reported on last year. I know we can't always know what's going on there, but would you agree that sort of the oil demand story is still going to be reliant on China, or less so in the year ahead compared to what we've had up to this point?
Yeah, look, I think it's still anchored by China, but I think increasingly the marginal barrel is becoming elsewhere, such as sort of India and emerging Asia. But China's still as important as it ever was. It's just not quite as monolithic as it once was. So we're seeing a little bit of a rotation in demand leadership across the region.
Okay, and where else would you see then those sort of pockets of demand coming from, if not from China? Which other economies would you identify, apart from India as well, which would sort of come
Yeah.
in and step into those shoes at least partially,
Sure. Well, of course, India's the big one.
Yeah.
But I think from the smaller scale side of things, you've got to look at Southeast Asia and emerging Asia. So the Thailands, the Malaysias, the Vietnams, maybe not so much in the oil markets, but certainly across some of the LNGs and some of the NGLs. The adoption of EV has been very big in China, which has sort of put
Yeah.
a bit of a penetration problem for them. And there's not been a recovery as such that a lot of people anticipated from China. So, this incremental demand starting to pop up in certain places that, weren't traditionally powerhouses. But I think in the years to come, they're going to play a much more pivotal role going forward.
And I mean, with prices as they are at the moment, if you look at just the crude price, obviously in the low 60s, has been for a while. The forecast in the year ahead is going to average around that. Not many people are saying it's going to go above. Is that a good low price cure for demand in countries like Vietnam and Indonesia, et cetera, that you've mentioned? Or do they need even lower oil prices, do you think, to really see that come out?
Well, I think it's a step in the right direction for them. Obviously, demand destruction comes from higher prices and a pivot into more dirty energy. From a crude perspective, there's always going to be demand there as refining capacity goes up and needs must across Asia. So I think you've got to look at where the capacity is going in these nations and what they're using as a feedstock. So that's going to be a
Hmm.
driver of their economies going forward, because certain of the countries, they don't have the financial firepower to be able to sustain relatively high prices.
Okay, and I mean, from a sort of next big shift, I mean, let's talk a bit about refining margins, because in China, those have been a little bit under pressure recently. But then again, last year in Europe, you had people saying, well, it was the products markets that were sort of leading crude, if you like. So
Yeah.
as we go into this year again, which one do you see leading the other? And, again, sort of addressing the refining capacity that is obviously coming online in China, and also so that the spreads between those.
Yeah, well, I think you have to look at the bigger picture, and if you look at what China's doing at the moment, they're upping capacity, they're building more
Yeah.
storage. So I think any talk of a supply glut, it is valid, but I think that supply glut will probably be absorbed quite quickly from the push to expand the storage capacities and the refining capacities. And margins will probably get better as economies of scale get involved. And then we have to start looking at China as the swing producer that they're now becoming. So while we're seeing an uptick on products coming in, they're certainly now becoming a much bigger player on the export market for middle
Yeah.
distillates, gas oil, fuel oil, things like that. And then obviously the gasoline to going quite well for them as well.
And I mean, what about, let's just look at LNG as well. US LNG, of course, trying to make a big push into Europe, has been replacing Russian oil partially, and of course, also going as far as Asia. But do you see that? I mean, also within the context of, the China-US trade dynamics as well, and relationship there, do you see the push that the current administration in America is making on everything, oil and gas, making more incremental sort of entry into Asia, or just will Qatar dominate, for example, into China? I mean, do you see those dynamics shifting in any way?
I think the geopolitical rhetoric at the moment is somewhat unstable, especially with the US and the Chinese
Yeah.
relationships. Uh, if you look at what's coming online ex-US over the next 5 to 15 years, it's certainly going to put some downward pressure on the market because there's just not enough capacity or demand, especially in Asia. Like I mentioned earlier, the bounce back after COVID hasn't been as significant as some thought.
Mm.
And I think pricing formula's not quite there at the moment. JKM, of course, is one that's used as a benchmark, but it's not ideal for the Chinese. And I think case in point is they're now moving to the Shanghai Futures Exchange in a yuan-denominated futures
Yeah.
contract. So that's going to have an impact going forward. But I think for the LNG market as a whole, more supply is good because price-sensitive nations have been priced out of the market historically. So it would be a good opportunity for them to get a foothold. We're seeing capex now on regas terminals in Southeast Asia. Uh, and again, volatility in oil is going to be a problematic factor because, index to Brent slopes is,
Yeah.
is the norm. So I think going forward, optionality is going to be a big deciding factor in procuring long-term contracts. But I think from a price perspective, short-term volatility aside, I think we're probably heading in a sort of lower fashion.
Okay. And I mean, let's talk a bit about Japan, because that's obviously a big LNG importer. It also, in parallel, is trying to revamp its nuclear plants. It has been already, obviously, and continues to do so. A lot of news out on the economic front with a new prime minister, and you just saw the success of her campaign very recently. Is the market watching Japan for a change in dynamic?
No, I think Japan's sort of got a gun held to its head via its energy security.
Mm.
It's wholly dependent on imports. So I think their playbook's not going to change. They're going to always be looking to secure more. They're going to be looking to up their inventories and storage capacity so they're in a safer position. So the same thing doesn't happen. You have to factor in there's new reactors and old reactors coming back online, and that might temper demand, but I think overall, having the diversification is only good for them.
Okay, I mean, just to quickly back to LNG, because you mentioned sort of new supply, but also like a lot of commentators are saying, well, it's tight at the moment, but given all the new supply that's coming online next year, really at the tail end of this year and into next year, are we facing possibly a glut, to come? I mean, I know that's a bit more medium-term outlook for you, but would you agree with that school of thought that we could be
Yeah,
facing a
yeah.
glut?
No, I definitely agree with that thought. I think we're going to have. I think if you look at demand drivers, and Asia being one of them, China in particular, it hasn't been there this year. It wasn't there at the end of last year, and I don't see any mitigating factor that's going to create a demand cyclone coming from China or Asia as a whole. I think there will be an artificial floor because as price comes down, more price sensitive nations step in. But overall, I think there's going to be a demand imbalance versus
Okay.
what's coming online.
And I mean, from a volatility point of view, obviously, commodities markets are volatile. We know that. We've had plenty of evidence of that in the last year, even. But
Yeah.
again, structurally, do you see that changing in any way? Is it, going to become a more predictive cyclical kind of volatility, or are we entering really a new unknown? If you put with, also the AI element that's going to bring a whole new,
Yeah.
sector of demand, et cetera, and the macro factors, obviously, that overshadow everything.
a little bit from column A and a little bit from column B.
Yeah.
I think as prices come down, there will be more incentive to buy. So as I say, they'll act as some sort of artificial floor. Overall, though, I think from a volatility perspective, it's somewhat baked in now. This is the new norm. Geopolitical risk pops up on any given day each week. So it's not just being able to forecast the cyclical nature of the heating demand or the cooling demand cycles. It's very much a case of, oh, what if the Strait of Hormuz gets shut down, or what if China decides they're backing out of US LNG entirely? I mean, these are things that are considerations that trading desks will be looking at. That's why optionality has become, the key factor in going forward in negotiations.
Okay. And I mean, would you agree that crude is lagging way behind other commodities and the only way is up? It's cheap, quote unquote, compared to other hard assets and anything out there, copper, gold, you name it, and even gas, that crude is really,
Well, I think it's just rotational. I think pod shops, hedge funds, speculative players are
mm,
jumping on what's hot at the moment. Crude is relatively boring. We like it like that. But I don't think it's lagging behind. I think it's just doing what it's always done, and that's being range bound in the constraints of where we are geopolitically.
yeah, but given all the geopolitical factors, it is very range bound, isn't it? I mean, in the past, you'd have much more, you'd have spikes on any headline. Now we don't. Is that just very simple demand supply economics that we've got too much crude around or not? What's keeping things so calm?
Well, look, I don't think things are so calm. I mean, we've had some big swings. I mean, there's ongoing uncertainty with key producers. What's happening with Iran, what they can do with the shipping lanes, what those barrels would mean if they were taken out. Is China going to wholly stop buying Iranian and Russian crude? I mean, there's a big step back from India and China, and that's a step in the right
Yeah.
direction. But if there's some sort of remediation and sanctions are lifted or at least relaxed, what's that going to mean for the market as a whole? And I think that's where you're going to see differentials push versus benchmark grades. So right now we've seen a rotation back into benchmarks because it's all a bit hot with the sanctioned gray barrels. But overall, I think volatility has been relatively manageable from a physical perspective. Of course, on the paper markets, it's entirely different.
Yeah.
And net short or net long, you could be caught out on either day, or you could be caught out going both long and short on each of the tail risks. So I think it's easy. I think it's better if you think about it in context of who's doing the trading, if it's the quant algo side or whether it's the physical players that are doing 25, 30 days in advance. Um, and that's going to be a key driver where liquidity is going to end up, or probably more importantly, where liquidity isn't at the moment.
Okay. And I mean, you mentioned China and India, the evidence of them taking less sanctioned crude, whether that's Russian or Iranian. I mean, this we saw those sanctions kind of change shape a little bit last year from the US and EU perspective, and more talk of we're going to get more stringent. But at the same time, the market's been largely ignoring sanctions, hasn't it? Because that crude has continued to flow. Do you, as a trader, ahead of a trading sort of division, see any change really in the year ahead to that, despite new stringent sort of on paper, more stringent rules coming out, but will we still see those volumes get to their destinations one way or another?
I think some of it's going to move. It's not
Mm,
going to stop in its entirety. I think those that do trade that type of product and barrel are going to find a way to do it and to get it landed. The discounts will probably widen as it gets harder to do that to sort of, I guess, entice buyers to come back to the market. But I think the US has done a fairly good job of implementing these sanctions, and that's evident with the Indians stepping back almost in entirety. And there's a bit to be said about some of the Indian refiners have two separate slates, one for
yeah.
domestic and one for export on their product side of things, and this is where optionality in different grades is going to come. Chinese moved away from the Venezuelan barrels because that discount wasn't quite there after the invasion. So what are they going to rotate into? Well, some of it's going to rotate into the benchmark grade differentials. Some of it's going to rotate into Canadian. And perhaps you might even see some of the teapot refiners even change their slate up to push out more of a middle distillate like yield.
Okay, and I mean, you went mentioned Venezuelan oil, and of course, Venezuela sits within OPEC as a group. I don't want to get too sort of OPEC focused or geopolitical on that front, but
Right.
of course, one big center of demand for the main Gulf producers is China, is Asia, and we have seen, of course, the US trying a little bit encroach on that space. Should OPEC, the sort of top OPEC producers, be in any way nervous about their market share? Do you think, given that they've sort of held off adding more oil in the last few months, etc., to try and presumably support the price where it's at?
No, I mean, I don't think they should be very concerned about it. With the rotation into other benchmarks, I think that's sort of
Mm.
buoying that market. I think it's going to be, it's a price issue now. I think it's going to come down to, is it an appealing grade not to rotate back into something gray? Is the trade-off worth it or such? But I think, failing cuts and other barrels coming to market, I think the status quo is going to remain largely unchanged.
Toby Copson, managing partner at Davenport Energy, thanks so much for joining us today and giving us your perspective on where the markets may be headed.
You're very welcome. It was a pleasure to be on. Thank you.